the essence of your piece this morning, I think, has been at the epicenter of your call for much of this year. You think the Federal Reserve is going to be too late, and when they start, they're going to have to move quickly. They're going to have to move faster than people expect. What's the argument that underpins that call, Bill?
Well, I think the issue is that the Fed learned some lessons from the last crisis, but they don't really apply to the current recovery. Lessons from the last crisis was that inflation, we had trouble pushing inflation back up to 2%. They thought full employment was at a higher level of the unemployment rate than it actually turned out to be. So they revised their monetary policy framework, and they said, well, we're really going to work really hard to push inflation up, and we're going to work really hard to push the unemployment rate down to a level past full employment. Well, that's great for that last cycle, but what about this cycle? We already have inflation above the Fed's target, and we have a lot of uncertainty about how much slack there actually is in the labor market. So I think the risk is that they're fighting the last war. The problem isn't inflation too low, the problem is inflation too high. And I think we also have all these questions about, how much slack do we actually have in the U.S. labor market today?
The when question is always hard, Bill, but it's a question we have to ask. When do you think this Federal Reserve will come to a realization of what you believe, and what will lead them to have that rethink?
Well, I think the interesting question they have in their current set of projections is they have the unemployment rate going below their view of what's maximum sustainable employment in 2022 and staying there through 2024. Yet they have in their forecast inflation falling over that period, and they have the Fed not getting back even to a neutral monetary policy setting by the end of 2024. So I think what they're going to realize is that if monetary policy is this easy for this long at this tight of a labor market, they're going to have more of an inflation consequence that they have written than what they've written down in their current set of projections.
Bill, if you're
right,
I
think they'll be forced to go faster.
Bill, if you're right, why have we not seen more material wage pressure, wage increases that actually exceed the pace of consumer inflation more dramatically?
Well, I think it's still early days. I mean, we've just emerged from the pandemic over the last year, and the unemployment rate's come down sharply over the last year. I think it's really too soon to say what's going to happen to wages. The employment cost index is the most reliable indicator on wages. That only comes out once a quarter. So we're looking backwards at sort of old information.
Bill, you've made the argument they have to get back to neutral more quickly. You've talked about the speed. Let's talk about the speed limit. What is the speed limit now? How high can they go with the Fed funds rate in an economy like this one?
Well, I think they can go a lot faster than what they penciled in. I mean, if you look people have reacted to the last FOMC meeting as the Fed being really hawkish. But if it takes 3 years to get to a median federal funds rate of 1.8%, that's not a very fast rate of tightening. A comparison would be the 2004-2006 episode, where the Fed raised the funds rate a quarter point, 17 consecutive FOMC meetings, taking the funds rate from 1% to 5.25%.
I
don't think it'll be that extreme, but it could be. It could be something a lot more than what they've got priced in.
17, I mean, not that extreme, Bill, but I'm just trying to understand whether this economy with this much debt can take those kind of moves.
Well, I think you're right that they're not going to get all the way to probably 5% because the economy will start to react to that burden. But it seems to me that it's reasonable to think that the Federal Reserve is going to have to get to a tight monetary policy setting before the end of 2024.